Good day and namaskar. Thanks for tuning in to Ojus Crypto, where we take a look at new and upcoming projects within the DeFi space. As always, keep in mind, nothing here is financial advice, and I am not your financial advisor. This channel is aimed at shedding some light on promising new projects and to be a stepping stone of your own research. If you like the content, please share and subscribe. If you have something to say, leave a comment below. This video was made to take a more critical look at NFTs, both by investors or the critics. Whether you are already buying NFTs or trying to explain them to your uncle, hopefully this video will be for both of you, covering a few red flags and use cases. An NFT is a non-fungible token, which means it is a unit that is without equal or has its own unique value. In contrast, Bitcoin is an example of a fungible token. You can trade one Bitcoin for another without question, and its representation on the blockchain will be identical. If you were to take a collection of NFTs, they may all have similar uses or benefits to holders. However, they would all be serialized and have specific numbers, values, and potentially images or behaviors. To frame this in a real-world example, you could have a group of NFTs that give you access to a concert, but each NFT gives you access to a specific seat. Are NFTs a scam? Short answer, no. NFTs are a technology. They are no more a scam than cash or email. However, like any technology, especially a new technology, one can find themselves taken advantage of or making decisions that aren't in their best interest. Hopefully this video will help with that. Before you invest in an NFT, it's important to identify why you're buying it and what you expect to get out of the purchase. Your research should directly correlate to your expectations and the complexity of your investment. If you're buying an NFT for a profile picture to use to represent yourself in Twitter, Discord, or some other social platform, so long as the purchase of the asset is legitimate, it's pretty straightforward. You pay a set price and you use it. Even if the developers run away with your money and do nothing with the project, you own that piece of art and can continue to use it or sell it to your heart's content. If this is your expectation, then even if nobody wants it and the speculative price tanks, you don't lose anything. In contrast, there will always be the possibility that the opposite could happen. Usually by an increase in scarcity, visibility, or utility, a collection can increase in price, sometimes quite significantly, and you can choose to sell your NFT for a profit. However, your mileage may vary. Keep in mind, the NFT doesn't give you full control to use it whenever you wish. While you have access to use it as a profile picture, some get more restricted if you want to make a profit. If you want to use a loaded lion as a main character in your video game, Crypto.com has a very specific user agreement denying that right, instead gaining its value on speculative uses, which opens up the next category, investing for utility. Unlike traditional purchase of goods and more similar to buying stocks, by buying an NFT, you are investing into a portion of that project. Do not expect a refund if you are unhappy. The more research you're able to do, the more informed you are, the better. For example, if you're investing in an NFT, that will give you lifetime access to a service such as lifetime dog walking, or gives you lifetime streaming on a new platform, and either one doesn't deliver or quits after 3 months, you have no recourse. You still have the NFT, but you may never get your promised utility. This can make it difficult to ensure that you aren't throwing your investment away. Thankfully, there are a few red flags you can look for to increase your chance of benefiting from the ownership. Is the developer-producer legitimate? Have they been around a while, and do they have a positive reputation? In other words, if they pull the rug out from the project, will it come back to haunt them? For example, if Disney were to make an NFT collection and promise a 50% discount on all services to holders, there would likely be a great deal of fallout and bad press, and arguably, worse financial consequences by not delivering that utility. Has the contract been audited? NFTs are not simply pictures, but have a place in the blockchain and are coded to act a certain way. If the developers are convinced they have a legitimate product and want to provide for their investors, they will usually be proactive and hire an outside agency to look over their code and give them a stamp of approval, ensuring that they do not have backdoors or other suspicious holes in their code. Keep in mind, problems could be backdoors or intentionally leaving out code that would prevent someone from clearing out the contract. Division of investment is important. The more evenly a project is divided up between its investors, the better sign of legitimacy. In any Web3 project, Once an entity starts holding over 5% of the total assets, it should start raising some red flags. The safest aspect within Web3 is decentralization, but as assets become more centralized, it begins to put the majority of investors at the mercy of the few, who are free to game them and their investment how they see fit. This concern is compounded if the largest wallets are the owners. A legitimate project will be set out to reward its investors, while a cash grab will create a system that will gather funds from their investor, but over time funnel all value to them. In the world of NFTs, a 2% commission is generally good, a 10% is high, and anything higher should be avoided. And these numbers can be offset by the price of a mint, so a 10% is much more reasonable if they are initially giving their NFT away for free. So what if your NFT is payouts, such as a native token or stablecoin, where investors get return from the project's success? If the project does have utility that requires management of funds, such as a treasury, can it be managed solely by the team? If the investors are putting 90% of the liquidity in, but the team has full control over the treasury, be very cautious or just skip it altogether. The benefit of Web3 is that protection from pulling all funds can be written into the contract. If the developers wanted to protect their investors from that, they would. If they didn't want to keep that option available, it would attract much larger investments if they protected their investors from it. In a company, the largest investors typically sit on a board and have a say in big decisions. Would any serious investor invest in this project? Do you see Warren Buffett buying significant stock in a company that are able to liquidate all assets and shut down in a moment's notice? If you invest in a project where the team has full access to dump and run at a whim, you can expect very little sympathy or recourse when that happens. Another use case would be membership or attendance. You may buy an NFT for admittance into a community. It may be a group of like-minded people that you could share stock tips, people you can arrange online games with, or for real-life meetups. NFTs could also be used to reserve your seat in events, such as a concert. When buying these, it's important to look at capabilities of a team. If you expect a community NFT to be useful for years, ensure that you have the confidence in the community leaders to engage people and keep it together for that long. If a legitimate band or Ticketmaster is selling you NFTs to a concert, it's likely more legitimate than an anonymous creator who set up their social accounts last month. More likely, an NFT project will be a combination of the above, and the more complex, the more research you should do before investing. For example, one of the most complex projects on the horizon right now, Beyond Earth Online, is set to be an NFT-incorporated MMORPG. Your NFT will earn you tokens, give you access to utilities, unlock features in the game, increase inherent value as you play, be mergeable, and potentially more. As one of the most ambitious NFT projects around, it has almost unlimited potential for growth. However, keep in mind that the more complex or groundbreaking the project, the higher potential, but also the greater risk of mistakes. Mistakes will likely happen, and that can range from a short delay on a mint or functionality to a complete drain of all liquidity. Pretty scary stuff. So, while there are risks to NFTs, there are great benefits, with a great deal of adoption to come in the future. It may not be too long before your mortgage is stored as an NFT. At the end of the day, although NFTs are not inherently scams, they aren't inherently safe either. They will become easier to use. If you're not ready, don't rush into anything. Educate yourself and understand that NFT or not, the less you know about an investment before you get in, the more of a gamble it becomes. If you made it this far, thank you. I hope you gained from it, and if you have any questions or comments for myself or the community, please leave your thoughts below. If you like the content and want to hear about more projects, your likes, shares, or subscribes are always appreciated. Until next time, let's get that crow and let it flow.